Iran is hoping that we cannot sustain this, which is a really bad miscalculation for the IRGC in Iran.
Hello and welcome to the Week Ahead on Nomura Podcasts. My name's Dominic Bunning, Head of G10 FX Strategy for Nomura in London, and today is Friday the 6th of March. Geopolitics has once again come to the fore for global markets, with US and Israeli strikes on Iran commencing on Saturday the 28th of February and Iran striking back. Continued exchanges going on through the last week. Our first thoughts obviously with those personally impacted by these events and the humanitarian issues created. But for markets, there are clearly significant implications which are already starting to play out. US Secretary of Defense Pete Hegseth made it clear in our intro in speaking to reporters that US resolve is strong, having already killed the Iran Supreme Leader Ali Khamenei early in these exchanges. But Iran has also made some notable strikes on military and energy infrastructure in the Gulf region. The most obvious impact for markets has been through energy prices, with the risk that a lack of shipping options out of the region caused longer-term production shutdowns. Brent crude has jumped from around $70 a barrel to nearly $90 a barrel, while European gas futures have risen around 60%, albeit from lower levels than at the start of the Russia-Ukraine war, which is being seen by many as the most obvious recent parallel for markets. These moves have seen equity markets sell off, bond yields jump, and the dollar strengthen notably. We're also recording this hot on the heels of a big downward surprise to US labour market data, so there's more than ever to discuss this week with a range of expert speakers. Let's get stuck in. Well, the focus right now in markets is clearly on the Middle East. So we're going to start this week on that topic with Zumrüt İmamoğlu, our chief economist for Turkey, who has many years' experience covering the region and has been highly engaged with a range of experts on the latest developments over the last week or so. Zumrüt, thank you very much for coming on the podcast. We're now a week into this conflict, and from where I'm sitting, at least, it isn't that obvious what the objectives are, given we've had multiple kind of rationales given by the US administration. From what you can gather, what do you think the US is really trying to achieve here? And on the flip side to that, how can Iran sort of deal with what's being thrown at them, for what it's worth?
Yes, thank you very much. Thank you for inviting me. This operation is joint with Israel and US. I think we should also consider what objectives Israel has for this, because actually Iran and its proxies have been a big problem for Israel for many years, and they have studied them for a long time. So this is a joint operation, and Israel, I think, have been a little bit more clear about the objectives than the United States recently, because they've been saying the same thing consistently over time. They said that the objective is to completely destroy the nuclear program and the missile program in Iran and create the conditions for a regime change internally. Because Israel's thinking is that there are people within Iran, civilians, who wants to throw out the regime, and as evidence, they show the recent protests and the past one. From US perspective, they completely agree with the Israelis on the nuclear and missile program destruction part, because they see this as a risk for US as well, and also US interest in the region, right, in the Gulf region. So they are completely on the same page on that front. In terms of regime change, US has not been very clear, but we know President Trump recently talked about choosing someone who will be the next administering Iran. He said, I should have a say in who will be next leader of Iran. So it seems like he has some interest there as well. And of course, militarily, they are trying to destroy the Navy and all the capacity stockpiles of missiles and production centers. So they don't only want to destroy their attack capability, but they want to make sure that these do not build up again, because that's what Iran has been doing. And I think that's where the regime change comes into play. They destroy some or most of the programs, but then the regime builds them back. I think the thinking is, let's go to a point where they cannot build it back, which might include a regime change, which might be potentially more friendly, let's say, to the region and beyond.
And in terms of then Iran, sort of how do they deal with this? Obviously they've launched a range of missiles. Do they have enough capability to withstand this for a very long period of time? We've obviously seen the former supreme leader be killed. So there's obviously they've faced some losses. Is this going to end in like a war of attrition in your view, or from what you can gather? Do you think there's scope for both sides to really want to push this a long way, or do you think we're maybe closer to getting some kind of cooling in tensions over the next week or so, without wanting to put you too much on the spot in terms of exact timelines?
Sure, it's impossible to know that, but Iran was prepared to this. I mean, they were expecting this, and they have years of experience as well. It is their homeland, so they have the advantage of being in their home, while US is on ships and Israel is trying to hit from a distance. But on the other hand, they have, of course, limited amount of capability themselves. They do have stockpiles and production centers, but these are being hit every day by US and Israel. So it's not as easy to keep the capacity up as usual. And the data so far, or evidence, let's say, from what has been going on since Saturday, shows that they are firing less number of ballistic missiles, and the attacks are more concentrated on drones now lately. This might be a sign that, yes, the capabilities might be diminishing over time. On the other hand, on the other side, again, in poor Gulf countries in the US, there's a discussion on stockpiles of interceptors that they need, or whether they have enough, the necessary weapons to deal with the drones from Iran. So we are at a point where both sides are having some issues with capabilities, but obviously this requires some time for both sides to see where this is going to go. We're not at the point where we can say Iran will quickly be stopping its attack. So yeah, time is important, and I think we will have to wait for a while more to see that clearly.
Okay, I mean, there's obviously a lot of uncertainties around all of these things in terms of timing. So we'll have to, like you say, watch and wait. But I think one area where I think there is a big focus is clearly on the impact for markets in terms of energy in particular, but also other forms of transit, particularly with the Strait of Hormuz effectively being closed for now. This is obviously kind of a pretty big deal in terms of the impact for the rest of the world. Do you have any kind of thoughts around how quickly that choke point might sort of get released? And also, just while we're on the topic of oil, for your own economy that you cover most in focus, Turkey, how big an impact does oil have in terms of the Turkish outlook?
Yes, the strait is de facto closed. I mean, Iran did not lay mines or actively engaging in deliberately closing the strait, but obviously for the ships, it's very high risk to go through a narrow strait where there are missiles and drones flying every day. So one way is to wait until Iran's ability to send these missiles and drones significantly diminishes to a point where there will be less worries and insurance will be a little bit more affordable to do this. How long that will take is very important for the oil markets, of course. Every day the pressure is building. So time, again, is the most important element here. Can they find a way to make this fast? It's hard. There have been some proposals by President Trump himself, helping with the insurance or helping with the security situation. But it's not clear whether these can also be done very quickly. So I'm afraid for the oil markets, it's also a waiting game at this point. Luckily, they were caught with excess supply going into this event. So we didn't really see the price levels that we have seen back in Russia-Ukraine conflict, at least so far. So yeah, we are watching. So from Turkey perspective, an energy importer and also a country in the region bordering Iran, of course, the risks are many. But we think that Turkey is also starting this crisis with a much better balance sheet than it had during the Russia-Ukraine crisis. First of all, its reserves are much higher. They used to be 120 billion. Now it's more than 200 billion in reserves. It has much better policies, more orthodox. They had an unorthodox mix in the past. And the credit ratings, the CDS of Turkey is still 240, which is low, and is able to finance its dollar debt very easily in the market still to this day. And we don't expect any risk here. And the impact on current account will be limited. If the oil price stayed at the current levels, 82 to 85, per barrel levels for Brent until the year end, we would expect up to $10 billion adding to the current account deficit of Turkey, which is less than a half percentage point of GDP. So it is financeable. The risk is inflation, the biggest problem in Turkey, as you know. So one channel is fuel prices, which now the finance ministry has declared that they will be increasing the subsidies for this. So only 25% of the oil price increase will be reflected in the fuel prices, which really helps with inflation. The second channel is natural gas and electricity prices for households. These are already highly subsidized, and I expect this to continue as well. The last channel is the industry prices. These are not subsidized. Again, it's a time problem. If oil prices are going to go down fast, these have indirect and much less impact on inflation. So probably the administration is going to wait and see what's happening in the markets. If things escalate and oil prices go higher, maybe there will be subsidies here too. Luckily, we have fiscal space. Turkey's debt to GDP is 24%, which is probably one of the lowest in the world. So they have fiscal space to deal with this crisis, in my opinion.
Okay, brilliant. Thanks for that. Really comprehensive. And thank you again for all of your insights into the broader regional conflict as well. So there's a lot to touch upon there. I think your comments around the Strait of Hormuz was certainly interesting. We've seen Donald Trump make some comments about maybe trying to get things moving. And we'll be talking to Jeremy soon about how the US might be thinking about things as well in terms of the impact of oil prices and various other things on their own economy. So certainly a lot to watch. And as always, we appreciate your views. Thank you very much.
Thank you. My pleasure.
We'll move on to the US now, where we've got Jeremy Schwartz, our senior US economist, joining us from New York. Thanks, Jeremy, for coming on. Look, we have to start with the Middle East, obviously. We've just heard from Zuma about some of the motivations maybe within the Middle East and the possible next steps, etc. From the US side, I think the big question a lot of people are asking is whether the administration might start to face some constraints, whether that be from the market or from sort of local polling, whatever it might be. Is there any sense from where you sit that there might be a sort of this might come to an end sooner because of any of those factors, or what would you be watching on that front to give you some sense of where we're going?
Yeah, well, so the messaging from the administration has been quite unclear about the objectives of the strikes on Iran in the first place. Whether it was just to reduce their military capabilities, whether it was to decapitate the current leadership, or whether, if you believe more recent messaging, the idea of potentially regime change, with Trump saying he needs to have a say in who the next leader is. And this morning, New York Times insisting on unconditional surrender. So the bid offer there is quite wide on what they're trying to accomplish. And it's tricky because while Trump has shown this proclivity to get stopped out by the market at times, whether it was last year with the trade war or at times with kind of other geopolitical conflicts, this time it does feel like you're still quite far from some of the major pain points, which could potentially force them into a more reactive approach. So, first off, while you've had some market stress, I think the overall situation for financial conditions remains relatively healthy. Equities are down, but not far from all-time highs. And even as you're getting some signs of stress in things like software and private credit, that's leading to more of a rotation rather than kind of a broad sell-off. So I think there's some decent amount of wiggle room there before this really turns into a financial market catalyst. The other piece is oil prices, which have risen, but probably far less than any of us might have expected if you were envisioning US and Israel strikes on Iran and potentially broader regional conflict in the Middle East. And something we've been emphasizing about this is actually, the US is relatively remote from the kind of immediate consequences of some of the energy disruptions. So the US doesn't import barrels from the Middle East anymore. We're largely self-sufficient, kind of even at times a net energy exporter. And we have no gearing to the global LNG market because of very ample domestic supply of piped gas. So some of the cost shocks simply aren't going to reach US consumers. The Trump administration also has some wiggle room in terms of reserves. So SPR is a little bit over 400 million barrels. They've talked down the potential for a release there, but it would help to alleviate some of the pressure on prices, particularly given the very sharp backwardation of the oil curve now. So I think they do have some room to maneuver. I think there are probably more dominoes we can expect to tumble before we see the administration really have to do an about face on some of their objectives in Iran.
Okay, interesting. So obviously, as you say, quite a wide range of potential outcomes, but certainly worth watching what they do on oil. I think that's very much the front of everyone's minds. Looking a bit more closer to home, I guess, from your side, we've just had the labour market data for February. The headline numbers were a bit of a shock to the downside. Do you want to sort of tell us what you're thinking about the labour market now in light of this latest data?
Yeah, so it was certainly a large downside surprise to the employment numbers. I think the way we're viewing this, though, is there's just a tremendous amount of noise in both January and February. So January, you had a large surprise to the upside. February, you had a large surprise to the downside. And actually, if you look component by component, it's the things which surged higher in the prior month gave back the most strength in February. So that looks like technical issues. It looks like maybe some bad seasonal adjustments. And what we can say is, the labor market seems to have stabilized since last year, but maybe some of the nascent signs of acceleration that we saw in the past couple of months should be downplayed at this point. In addition to the downside surprise on NFP, you also had some negative revisions. Private payrolls for December is now in negative territory. That 172K print in January was revised substantially lower. And then on the unemployment rates, there were some technical factors as well. This month, you had new population adjustments, which the BLS includes every year, which actually caused a slight upward revision to the unemployment rate for January. So the sequential increase was not quite so bad as the headlines indicated. But still, whereas coming into this number, you might have said you saw some signs of green shoots for a potential acceleration. Now I'd say the broader picture is much more of a stabilization. We still think that growth momentum looks quite healthy in the US. You've seen a lot of lead indicators for business capex picking up. You've seen sentiment for businesses turning higher. And we eventually do think that that's going to find its way into the labor market. We continue to expect NFP to accelerate in 2026 relative to 2025. And we think the unemployment rate should eventually begin to make some progress lower. But I think that's a little bit further in the future than some of the most recent indicators had indicated before this number.
Okay, interesting stuff. So, a few technical things in there, a little bit of a stabilization, but certainly not a complete collapse, as maybe if you just look to the single headline number on NFP, you might be talking about. On the other side of the Fed's mandate, I guess, it's not just employment, it's obviously inflation that matters. We've got CPI data next week. Do you see signs of still kind of fairly hot do you see signs of fairly sticky or even hotter inflation coming through this month?
Yeah, so we do think you get a decent sequential slowdown in inflation in February. So we think that core CPI likely decelerated to around 24 basis points, down from a 0.295 in January. I think more importantly for the Fed, you're going to get a little bit of slowdown in core PCE, which we think slowed from 44 basis points in January down to 25 in February. So I think not any signs of an acceleration in inflation, but I'd say the rate you're cooling down to is still far too high for the Fed. That's still close to a 3% annualized pace, just looking at the February number. And we think some of the details are going to be less constructive. So a lot of the slowdown we think is in factors like used autos and airfares, which tend to be quite noisy, and you shouldn't extrapolate too much from the weakness there. At the same time, we see OER inflation for rents actually picking up a little bit in this report. So, decent headlines. The run rate is still too high. And I'd say the overall mix of inflation should be concerning enough to keep the Fed from being overly proactive about taking out any insurance against some labor market or financial market stress.
Okay, brilliant. Very clear as always, Jeremy. Thank you very much for joining us. And we look forward to having you back on soon. I'm sure you'll be very busy in the week ahead. Thanks a lot.
Cheers.
We're going to move to Asia now, where we're joined by Sonal Varma, our chief economist for the region. Sonal, The focus is clearly on the Middle East, and I know you and your colleagues have put out a fairly chunky report on the impact of this on Asia. What are your key takeaways, and are there any sort of country divergences that we should be thinking about here?
Yeah, Dom, I mean, it's quite negative for Asia. I would say it's actually the region is at the epicenter of the energy shock because most countries here are net oil and gas importers. Most of this is actually sourced from the Middle East and via the Strait of Hormuz. So there are some alternate pipelines, but they really can't offset the loss in volume. So, and the countries here, they have buffer stocks, but basically it's less than 1 month of buffer stock. So essentially they're facing, both a energy price shock, but also a volume shock because supply is actually getting cut. So it's quite stagflationary. Now, within the region, I mean, there are some divergences. In general, our view is there are more losers than winners. The countries we think that are more vulnerable include Thailand, Korea, India, Philippines. These are net importer of oil and gas, and a lot of the purchases are concentrated in the Middle East. The winners, we think, are potentially Australia and Malaysia, both net energy exporter. Malaysia imports crude, but exports LNG, so they could benefit. But on the whole, stagflationary, negative, and I don't think there's runway for more than 1 month to face this supply shock.
Okay, sounds pretty challenging. In terms of policies, response to this, are you guys thinking any differently about central banks or government policies? Is anything going to change dramatically on the back of what we're seeing in the Middle East?
Yeah, I think there are three things here. One is actually the top priority right now is really to find supply alternatives. So we're seeing, potential drawdown from strategic reserves and commercial stocks, figuring out what alternate routes and pipelines can be used, locating some new energy sources. So in the US, Brazil, West Africa, India has been given a 1 month license to buy Russian oil, which is stranded at sea, and potentially switching to new energy sources. So, can countries use coal instead of gas? So this is sort of the near-term focus. How do you address the sudden supply shortage? We do think fiscal policy is going to be the first line of defense. Governments do want to protect consumers. So we do expect pump prices to be left unchanged. So there will be more subsidies given, some tax cuts. So the pressure will be seen more on fiscal than on inflation. And on monetary policy, central banks are on wait and watch. There's, I think, a lot of uncertainty on just the duration of this shock. It does add to some inflation pressure, but this is more supply side. And this shock is also negative for growth. So we do think that while markets are now starting to get nervous on rate hikes, we do think that the bar to hike rates from central banks is quite high, and a hold is more likely for now.
Okay, brilliant. That's very, very comprehensive. Look, we're obviously really focused on what's happening with the Middle East, energy prices, etc., for a number of reasons. But there's also the run-of-the-mill data to focus on as well every week. In Asia, I think we've got some pretty important numbers coming out of China and India. What are we thinking for the week ahead?
Yeah, China, we get the inflation and trade data. So on inflation, we're expecting CPI inflation to move up to 0.8% in February from 0.2 in Jan. But this is mainly because of the shift in the timing of the Lunar New Year holiday. The PPI deflation, we think, will ease slightly, but still in negative. On the trade front, we'll be getting the combined Jan-Feb trade data. We're expecting export growth to be broadly steady at around 6%. For India, the main focus is on CPI inflation. This is going to be the second print under the new series. We expect it to inch slightly higher to 3.1 from 2.7, but this is again mainly food driven, and core still remains quite soft for now.
Brilliant. So very comprehensive as always. Really appreciate your insights, and thank you very much. We'll be speaking to you soon. Have a good week ahead.
Thanks a lot, Dom.
We're going to finish this week in Europe, where I'm joined by Josie Anderson from our economics team. Josie, thank you very much for coming on this week. We've asked everyone the same question, basically, but what are the major impacts from the Middle East developments on Europe, in your view?
Yeah, so if we start by thinking about the ECB and the euro area, well, to quote their research, a 10% change in oil prices has a 0.4 percentage point impact on headline inflation, and then there can be further secondary impacts, adding another 0.2 percentage points to inflation. So that's the numbers we're talking about. But of course, a key thing that the central banks in Europe are thinking about is the duration of this crisis, and therefore how long it impacts oil prices for, because that will have a key impact on inflation. In thinking about how the pass-through to inflation will work, we'll see a relatively quick impact on pump prices, but then it takes longer to feed through into household energy bills, and then potential second-round effects come after that. But a quicker resolution to this conflict would mean a much shorter impact and potentially fewer second-round impacts of any spike of inflation that we see as a result of this crisis.
Okay, so yeah, clearly the duration being an issue. We've spoken about that with Zumrud already and everyone else on the call. So that's definitely something we're all focused on. Despite it only being a week into this conflict, have we already seen any shifts in our thinking in terms of policy response?
Yes, and if I start on the UK for this answer, we have changed our view of the Bank of England and its policy rate path. We had previously expected a cut at the March meeting and another in June. But as a result of this, we are changing our call to rate cuts in April and July. We already thought the bar to changing the cut expectation from March to April was pretty low, and that's because data already going into this had looked slightly sticky, particularly on services inflation. But as a result of this crisis in the Middle East, we now expect the Bank of England to want to wait for more information in March, and therefore, we expect now an April cut from the Bank of England, so a delay as a result of the conflict. In the euro area, we do think the bar to moving rates is higher. We currently think that they won't change the policy rate until 2028, and we expect hikes then. Obviously, this crisis has raised the risk of earlier hikes than that, and that is something that the ECB will be focusing on in terms of considering its inflation forecast, and therefore whether an earlier hike or a hike this year even is necessary. But for now, we expect them to look through changes in prices if their end horizon forecast for inflation is still looking around 2%.
Okay, so change of view in the Bank of England, certainly in terms of the timing, but a bit more up in the air in terms of the ECB. Still waiting and watching on that. In terms of waiting and watching, week ahead, not necessarily any huge data points, but is there anything that you're keeping your eye on in Europe in the next week?
Yeah, a few things to mention here briefly. On Monday, we get factory orders and industrial production data in Germany. Orders in particular have looked a lot stronger lately, and we'll be looking out to see if there's another solid rise. And we're attributing the recent improvements in the data to this large fiscal boost that's coming from the German government for investment and defense spending. We'll get industrial production data at the same time on Monday. Though that's taking longer to show signs of this government boost on fiscal spending, but we're expecting that to come through later into the year, so we'll be keeping an eye on that. We also get UK GDP growth for January out on Friday. We're expecting a slight tick up there because surveys improved at the start of the year. That follows a lackluster end to 2025. And finally, we also get inflation data for Norway. That's looked very sticky lately. We're expecting quite a chunky fall, but that's mostly due to base effects rather than particular disinflation. So that's something to watch there.
Thanks, Josie. Informative as always. Thanks for coming on, and we look forward to speaking with you soon. Have a good week ahead.
Thanks, Tom.
Well, that's it for this week. Thank you, as always, for listening to the Week Ahead podcast, which is edited and produced by John Dalton. Please like and subscribe to the podcast using the usual channels, and feel free to leave us feedback and tell us what you like and what you want to hear more of. If you're enjoying the podcast, please do recommend it to friends, family, colleagues, and anyone else you think might be interested. You can also check out nomuraconnects.com for more of our research and updates. Thanks once again, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another. One investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.